Hi everybody, and welcome to the ESG Demystified training series. This is session 2, where we're going to be covering off sustainable debt instruments. My name is Dominic Brindley, the head of the public sector team here at NatWest. You're going to hear today from Dr. Arthur Crevers, head of sustainable finance for corporates, and also from Nathan Holland from our loan markets team around sustainably linked loans. Just in terms of a reminder on the format of the training series, we've created this to be accessible for treasury and finance staff, going to be taught by a range of NatWest experts focused on ESG aspects that are most relevant for the public sector clients, but just clearly call out that actually the curriculum can be shaped by your feedback. So if there are specific areas that you would like to cover, or that you haven't seen or that you're interested in, please do let us know, and we can shape the series as we move forwards. So just in terms of turning to today's session on the training topics, as I alluded to, we're going to be covering sustainable debt instruments. We're going to hear from Arthur in a second about the key concepts, and I suppose the two areas that we're going to focus today are use of proceeds, capital markets instruments. There has been a multitude of different variations, but this is probably the predominant use of ESG related debt. And we're also going to hear from Nathan around sustainably linked loans. Increasingly important, I guess, in terms of public sector. We have seen the likes of Clarion Housing Group issue the first sustainable bond in the social housing sector, with great success, and Arthur will no doubt touch on that as well as many other thoughts as we go forward. So I guess without further ado, I'm going to hand over to Arthur, who's going to kick off with the key concepts. Arthur, over to you.
Great, thank you very much, Dominic. And indeed, before we dive into the specifics of the main bond, PP and loan market instruments, it's probably helpful to discuss briefly the key types of technologies that are applied to sustainable finance debt instruments. If we turn to the next slide, you'll see there the two main types of instruments that you see applied across different liabilities. So the first one is use of proceeds, and that is a like-for-like quantitative commitment. So I raise £100 million in sustainability labelled financing, which means I commit to investing £100 million in projects and or assets with an environmental and or social characteristic. So that's key. It's a like-for-like commitment. The money's being directed towards a subset of an organization's projects and assets. The other type that is prominent, and as Dom has mentioned, is quite prominent in the revolving credit facility market, as Nathan will talk to, is the number 2 there, the KPI linked approach. Here the stability technology rests more in the pricing, the debt instrument, where the margin or the coupon is partly linked to the organization meeting or not meeting a sustainability target. So you see here that both those types of instruments have now well-developed industry standards. Both the ICMA, International Capital Markets Association, has been developing principles for bond and capital markets instruments, and the LMA, Loan Markets Association, has been developing principles as well for bank lending products with such technology. And an important development in the coming years will be the introduction of the EU green bond standards there for that first category, the use of proceeds when targeted at green or environmental projects. Very briefly, in terms of the advantages and the considerations between both these types of instruments, it's fair to say that use of proceeds is most established in the capital markets, while the KPI linked approach is probably the most established structure in the revolving credit facility market. So bear that in mind when thinking about the end investor for the liability. For a use of proceeds instrument, what's quite appealing for companies is that they can tangibly link specific CapEx, specific sustainability initiatives and money outflows to their financing agenda. And also it allows them to provide quite a high amount of transparency on what's happening with the money, which for a lot of their impact stakeholders, impact investors is quite important. Of course, on the use of proceeds side, that is also constrained. That's a use of proceeds pledge. Again, back to that £100 million example, you need to, throughout the life of the debt instrument, have 100 million portfolio in sustainability focused projects or assets. That requires certain data generation exercise. And there's a whole debate also around additionality, because very often organizations will focus on projects that they've already executed in the years before the sustainability debt instrument was announced. KPI linked approach, what can be quite appealing is that if you set the target well, it can be quite a holistic target, and hence not just focus on a subset of projects, but on a company's overall strategy and direction. It has flexibility clearly around use of proceeds, which is very helpful from a treasury point of view. And it also deals quite effectively with the whole debate around sustainability and its economics, because here there's a real pricing incentive to do the right thing. On the flip side, for KPI-linked instruments, you do need to identify a compelling target. It's not supposed to be business as usual or a target you're going to meet anyway. You're trying to show you're stretching the organization's resources a bit. There's a whole debate around how penalizing should that pricing margin be. And I've got to be open as well. In the capital markets, so far the structures have just been step-ups. So you pay more if you don't meet a target, and not necessarily pay less if you do meet a target. And that's only the case for the capital markets, as Nathan will talk to. It's a bit more symmetric in the loan markets. With that as setting the scene, why don't we go into the first category, which is the use of proceeds capital markets instrument. And if we turn to the next slide, by way of quick recap, I briefly mentioned ICMA already. The main documents to be familiar with when thinking about one of these instruments are the ICMA green bond, social bond, and sustainability bond principles and guidelines. And again, you'll remember from our last session, green is an environmental focus, social focused on disadvantaged populations, peoples, and sustainability is a combination of environmental and people impact. When we turn to the next slide, so when you're thinking about issuing a sustainability use of proceeds bond or private placement or other drawn debt instrument, well, as I emphasized at the beginning, it's focused on a subset of projects and assets. It is still very important that you do so in a way that's seen as being consistent with your organization's overall sustainability strategy and ethos. And I think this slide sets that out very well. So if you look at the top row there, the organization's strategy, CSR, your investment plan, and your treasury and financing approach, that's fundamental. And from that, and from those priorities, you set up a framework, that's number 2 there, that meets these ICMA principles for sustainability and sustainability debt. And once you've set up that framework, you can do underlying debt issuance, again, bonds, private placements, loans, commercial paper, etc. But of course, most frequently, we have seen bonds. So I guess next question is, what then is required to be entered into one of these bond sustainability frameworks? On the next slide, we've got the 5 key components that are quite consistent between the different ICMA and indeed other market standards. So one of these sustainability finance frameworks, focusing use of proceeds, tends to be about a 5 or 6 page document that's almost an annex to the prospectus for the debt instrument, that describes the procedures you as an organization will take and adhere to whenever you label one of your debt instruments as sustainable, or indeed as green or as social. And those mechanics are really split in between sort of 5 components, 5 chapters, which you see here on the slide. So the first one, use of proceeds. If you raise financing under a sustainability banner, what type of project categories will you be investing that money into? Is that renewable energy? Is that affordable housing? Is that green buildings? Is that research and development targeted at new environmental algorithms and software, etc.? There could be quite a broad range of projects in scope. The second one, the process for selection. Who will decide how the money gets dispersed? Who will maintain oversight over this framework? And that tends to be a committee of finance and sustainability representatives from the organization. Third component, management of proceeds. Well, what if, in my earlier example, you had raised £100 million, but you'd only identified 50 million of eligible projects? What happens to the residual 50 million in the interim? And typically, there's quite a bit of flexibility there in terms of parking that cash in deposits, in short-term money market instruments, etc. Number 4, this is quite critical, reporting. Okay, day 1, you've raised 100 million sustainability debt. When will you revert back to your investors, to your other stakeholders, on how that money was spent and on whether those projects were as environmentally and socially impactful as you had hoped? And that's in the form of what is known as an allocation and impact report. And typically those are expected a year after the issuance of the debt instrument. And then finally, the external review. Don't just take our word for it as an organization. We've also gotten the opinion of an environmental and social agency, which is what's called a second-party opinion, to provide a degree of assurance around the framework, the expected environmental social benefits of the projects, etc. And that tends to be quite an important decision for you as an organization to make, because it's quite unusual to switch between such opinion providers. In terms of projects, if we go to the next slide, it's a nice graphic overview of some of the most common categories we've seen used within the public sector, and hopefully a lot of initiatives that your organization is also focused on. Then thinking about the benefits and considerations, if we go to the following slide. So what are the drivers for organizations to issue such an instrument? Well, you see on the left-hand side some of the common reasons that we hear from clients. Marketing can sound a little bit negative, but it is often of major intangible benefit, and particularly that second point there, that the treasury commitment. Issuing a sustainability bond is often one of the most high-profile actions that a finance or treasury team can do to show that they support the organization's overall CSR, sustainability, carbon transition, or otherwise impact agenda. It's something that reaches a lot of stakeholders and draws in a lot of positive attention. Investor diversification, that is meaningful. Dom mentioned earlier the Clarion sustainability bond that we did. Within the context of that bond trade, we saw significant increased uptake from European and also global investors who perhaps wouldn't have otherwise looked into a UK Housing Association debt instrument. So that is meaningful, particularly because there is such an asymmetry between the amount of sustainability debt that's in the market, which is about 2% of global debt outstanding, and the demand from investors, which is a multiple of that. And of course, with investor diversification does come potential pricing benefit. Second order, you'll see on the slide, we've seen that in a lot of cases where sustainability bonds tend to trade more in a more stable way, tend to outperform, which is of course helpful for your cost of debt going forward. And other reasons, and clearly important for the public sector, is political pressures, right? If a government such as the UK has set a carbon net neutral target and an industrial and political strategy around that, it becomes incredibly important for the public sector to be seen to support that in all of their operations, including the way they fund themselves. Considerations on the right-hand side: upfront cost. The main cost is the second-party opinion that I referred to earlier. That tends to be in the region of 15 to 20,000 pounds for the framework. There's running costs involved with clearly maintaining the framework, ensuring it continues to meet the latest market standards, reflect the latest developments at your organization. And of course, there's and that's probably the most material, that there's real management time involved there as well. These processes to set up a framework can be as quick as 4 to 6 weeks. If you have all the data, if you're very clear about what you'd like to put in the framework, but it can also drag on a little bit beyond that as well. On the next slide, I guess to make this whole product a little bit more tangible, we have illustrated here a couple of examples from the UK market from this year alone. These were all debut instruments, and you'll see that it includes a nice mix of sectors. Quite recently, we issued a sustainability bond for Burberry, which helped them refurbish a lot of their stores and also help them with their OPEX for more sustainable cotton. Early in the year, we did a transaction for Cadent. That was a transition bond, slightly different label, similar infrastructure and technology as what I've been describing earlier. And a lot of that money went towards retrofitting their gas grid around London in particular, to make that hydrogen enabled. Equally, as Dom mentioned, we have issued a sustainability bond for Clarion, which has helped them both in terms of investments in more affordable housing, but besides that also more carbon and energy efficient new builds as well, which is the first from the social housing sector. And as mentioned, that had a very strong international investor appeal. And finally, Southern Water, following a growing trend amongst UK water companies to embrace this market and link that to their water management, water efficiency agenda, but often also their social agenda in supporting more vulnerable customers and indeed farming tenants as well. What does the timeline look like? On the next slide, we give you very high level the overview. As mentioned, this is very much the best case scenario, so the 4 to 6 weeks, and it does very much assume that you have your ducks in a row there in terms of the types of projects you'd like to finance, and in terms of the financial and the environmental and social data that you intend to report on those projects, because that data exercise tends to be the most time intensive. You'll see that leads to project selection, so setting out a list of projects that the framework will finance, which informs the basis of the rest of the framework, that stage 2 there. And then following on from that, you'll see that 3, 4, and 5 are all stages you'll be familiar with from a regular bond or debt financing exercise. The docs, the marketing, and the execution. There's some sustainability overlays, but not too complex. And then finally, so the aftermarket servicing, the project reporting, that tends to occur a year after issuance, as mentioned. Perhaps turning for the final 2 slides on my section to the private placement use case, because I think that's very important and growing. I think what's quite beneficial in the context of using sustainability label for a private placement issuance is firstly that it allows you to be very specific in what types of projects you are intending to finance. You may even decide to do a PP for one specific high-profile project that you intend to announce and fund. So that makes that incredibly tangible, which can be very appealing to investors that care about the following the money and also promoting their own impact on the real economy. Also, what's of course key with a PP issuance is that the investor base, being long-term holders of quite illiquid debt instruments, already have quite an elaborate due diligence exercise. And increasingly, we are seeing that ESG considerations, particularly climate change, are naturally being embedded in that. And as you see on the slide there, that's particularly true for the European, Canadian, and Asian investor base. ESG factors are becoming more and more of a potential risk and consideration for them when thinking about a 10-year plus holding horizon. The US is not too far behind, as we've seen in recent green USPP exercises. A specific instrument label, that this is back to my earlier point about marketing. If you are financing a very specific project, you may decide to not just call it a green PP, but maybe also a circular economy private placement or a water management private placement, as the project category may be. And then finally, economies of scale. Even if your intention is to begin quite small and quite targeted with your sustainable finance agenda, we would always recommend what we call a family framework. So setting up a more holistic framework that can allow multiple private placement issuances and maybe in the future a bond issuance as well. And finally, in terms of some examples of private placements, on the next slide, there's two there. Very recently, we did a private placement for Kingspan that shows you what kind of size is possible, which was linked to their Planet Passionate agenda focused on building insulation and other building energy efficiency measures. And it was very encouraging to see that a number of the US investors there were actually quite focused on the environmental components of that proposition. And then secondly, again, in the UK water co space, last year we issued a private placement for Southeast Water, which was their first ever green issuance. And again, it ties in incredibly well to kind of regulatory and business plan commitments that they're making as a water co. With that, let me hand it over to Nathan to talk you through the sustainable lending product.
Thanks, Arthur. For the next section, I'll run through the latest developments on the loan side from an ESG perspective, some of the trends we expect to see going forward, and how incorporating sustainability features into loans is applicable and very relevant for the public sector. Starting off, there sometimes can be some misconceptions about sustainability-linked loans around how they work, as well as having quite a few different names, which can lead to some confusion. But essentially, sustainability-linked loans are loan facilities which incorporate sustainability-related KPIs in the form of annual targets for the borrower. A good starting point and guide for this is the Loan Markets Association principles, which were published in 2019, as outlined on the slide and alluded to by Arthur just now. And the principles state that these targets should be ambitious and demonstrate positive sustainability performance and improvement. So an example of this could be a reduction in the carbon emissions for a business for each year during the life of the loan facility, for instance. Now, if those targets are met, a small discount can be applied to the margin. However, the driver behind incorporating sustainability is the statement of intent and positive story that it sends rather than economic reasons at the moment. The KPIs and the targets chosen should reflect the overall sustainability objectives of the borrower and really what they deem as the most important to them and to their sustainability strategy. Moving on to what we currently see from our clients and the market. The level of interest and discussion on sustainability-linked loans has really continued to grow as borrowers are increasingly looking to include sustainability features into their core loan financings. Now, if you look at the volume of sustainability-linked loans globally, it still remains strong this year, despite the challenges to market conditions caused by COVID. And as refinancing start to pick up again, we expect that to accelerate the amount of sustainability-linked loan issuance once again. To give you an idea of the scale of the market worldwide, the volume of such deals so far this year is close to $60 billion. And a majority of that volume is coming out of Europe, comprising 89% of the total global volume. And whilst sustainability-linked loans are gaining further traction in both the US and in Asia, European companies are still leading the way, including in the UK. And in the UK, we have seen borrowers complete sustainability-linked loans across a really wide range of sectors. And that's become very apparent, particularly in the past 1 to 2 years, including recently a small number of public sector institutions as well. A key trend that has developed in the past year has been around the number of KPIs being used and that number increasing. Most deals now have multiple KPIs, and in some cases, it's as many as 4 or 5 different KPIs being used on a sustainability-linked loan. Based on our transaction data, the average number of KPIs used on a loan is now close to 3, whereas if you compare that to a few years ago, it was around 2 or even below 2. And whilst environmental-based targets that are still the most common type of KPI, we are seeing a much greater focus on the social and governance aspects of ESG from companies. And that also has been a driver in the number of KPIs going up on sustainability-linked loans. Almost a quarter of KPIs are now either social or governance related, whereas a couple of years ago, that number was close to 0. And that's a trend we really expect to continue going forward as borrowers seek to encompass the full ESG spectrum rather than just environmental factors. And that rise of social and governance factors lends itself especially to certain sectors, such as the public sector. And many public sector institutions will already be producing data, strategy, and targets around such factors. For instance, we have seen in the housing association space, borrowers include social targets around assisting tenants in attaining full-time employment as part of their social programs. A common question that we often receive from clients is, okay, so how do you incorporate sustainability into our loan financing, and what's the level of work required in order to do this? And it's often the case, actually, that borrowers already have sustainability objectives and targets in some form, and they're doing quite a bit of the work around this. And that's really where the bulk of the work is, to incorporate sustainability into a loan. So the other work that is also needed for a sustainability-linked loan is that the targets set, they need to be on an annual basis. They need to be set at the start of the loan, and they need to show that improvement in performance year on year. The facility agreement for the loan will then include an undertaking that stipulates and requires the borrower to provide its sustainability KPI performance to the lenders each year. And that's usually provided using a sustainability certificate that's included as a schedule in the facility agreement. The performance is then judged against the target set. And if the targets are met, typically a small discount is applied to the margin. And likewise, if the targets are missed, typically in the syndicated loan market, the equivalent premium is added onto the margin. Now, the amount of margin discount is somewhat limited, as this comes at a loss to lenders, as there is not a difference in capital treatment for a sustainability-linked loan compared to a non-sustainability-linked loan currently. But the benefit to borrowers of incorporating sustainability targets is that they are aligning their sustainability strategy into their financing, and the positive messaging and story that this creates, both from an internal and from an external perspective. So whilst borrowers are often at different stages of their sustainability strategies, objectives, and the journey that they're going on around their sustainability work, we expect the level of interest and demand in sustainability financing as a whole only to just grow and develop even further, and that this will remain a very, very key topic in the loan market. So with that, I'll hand back to Dom for the Q&A session.
Thanks very much for that, Nathan and Arthur as well. Very insightful. And with that, we're going to open the floor to questions. Yeah, thanks very much. We've had some questions coming in while we've been going forward. I suppose the first question here, probably for Arthur, is there a pricing benefit for issuing sustainable debt in the sterling bond markets?
Yeah, it's an excellent question. And if I would have been asked that a year ago, probably the answer would have been no. We haven't really seen really tangible differences, particularly given in the use of proceeds context. The exposure of the investor is clearly still to the same sort of credit risk. There's no different covenants or collateral. That has changed, particularly in the last 6 to 9 months. And we've now seen examples where, at least on average, the saving is around about five basis points. Again, that'll depend on tenor, on sector, on rating, but that's a good sort of thumb in the air guide, I think. Of course, if it's a KPI linked instrument, then the like we saw with Vanel yesterday, then of course it's embedded in the actual coupon step dynamics.
Thanks, Arthur. That's very clear. There's another question that's come in terms of it's a question on margin changes. So probably direct that to Nathan. Is what is the likely range of margin changes for RCFs?
Yeah, it's a common question as to what the economic benefit of having sustainability features in a loan is. And today it has been quite limited so far. The reason for that is because banks are essentially taking that discount on the margin as a loss, and they don't receive a beneficial capital treatment for providing such loans. In the market, this range, it is, as I say, it's limited. In most cases, is up to 2.5 basis points. On some deals which have higher margins that are into, say, 100, 200 plus on the margin, there may be scope to increase that a bit more, and we've seen 1 or 2 examples of up to 5 basis points. But as I say, as a percentage of the overall margin, it's fairly limited. And the benefit and the reason for borrowers doing this is more around being able to incorporate sustainability into their financing and the positive story and messaging that sends.
Right. Thanks very much for that, Nathan. Probably just an observation, actually. I think you mentioned around the capital aspects. I think there could be some changes that are coming from a capital regime perspective that may see that change over time, depending on how the regulators feel about the pace of change in terms of what's required. I have had another question in. It's probably just for you, Arthur. You mentioned both the use of proceeds and KPI-linked approach to debt capital markets. What are we seeing most clients in the public sector gravitating towards? I think you made mention of the NL deal yesterday, but if you could pass comment on that, that'd be great.
Absolutely. Looking at issuance to date, the public sector side, virtually all of that within the capital markets has had a use of proceeds element. And I think that's reflective of the sector having relatively tangible capital expenditure and also relatively clear linkage between that and its and their overall carbon transition and sustainability objectives. And I would say as well that structure, the use of proceeds structure, has been able to generate the widest investor support for any sort of public sector sustainable debt issuance. So that has been the default. But this is a fast-moving space where innovation is supported. So we may well see examples, in the coming year of also public sector names applying the KPI-linked approach.
Great, thanks. And I suppose while you're there, Arthur, there's a follow-on question from that is with regards to sort of US private placements? How can we encourage US-based investors to support ESG credentials?
It's an excellent question, and we are working on that. I was actually at the annual USPP conference at the beginning of the year to encourage them to get more in line and focused on this agenda, because it is fair to say that their level of questioning around ESG is still somewhat behind their European PP and their Canadian and indeed Asian PP counterparts. With all these developments, there's a degree of top-down push from sort of central political stakeholders, and a degree of bottom-up push from end clients that's required. And clearly in the US, it's been mostly the latter, where it's been asset owners, where it's been companies who individual companies who have been embracing this agenda. So there is growth, and we are starting to see USPP investors take note. But unfortunately, the pace of change is slower than with others. Potentially, a final point there. I think what one thing that would help is also improve data around climate change exposure that these investors have. I think was some interesting comments recently from Lagarde, the head of the ECB, saying that she doesn't think the market at the moment prices in climate change risk in any proper way. So once you start seeing that happen, then I think a lot of long-term investors, as PP investors are, will probably wake up to that dynamic.
That's great. Thank you, Arthur. Nathan, probably a question for you is what proportion of all sort of syndicated loans in the UK market have a sustainability feature included in them?
Yeah, so the proportion of UK syndicated loans that have a sustainability link, it's still fair to say it's a minority. It's, I would say, below 25% of total deals have a sustainability link. But that number is rapidly on the rise. So, I mean, the first sustainability linked deals in the UK, we saw those in 2018, and it was just a handful. But over the past 2 years, that number is rising and rising. And also, judging by the discussions that we're having with clients across all sectors, and those that are coming to do their refinancings, be it later on this year or going into next year, that number and that proportion of sustainability linked loans is only going to increase. And that's a trend that we see across the board, as I say, all different sectors in the UK and also across Europe as well.
Great, thanks for that. A follow-up question, Arthur, probably for you. Just out of interest, have we seen or expect to see a potential callability feature from investors' perspective if the issuer fails to meet the sustainability target? And I guess following on from that, there's a secondary question for you, Nathan, is to what extent the banks scrutinise the KPIs and targets proposed by borrowers. So Arthur, if you answer the question around the investor perspective, and then Nathan, perhaps you can give a view on the KPI scrutiny point.
Absolutely, it's a question that we've been closely following, and that dynamic with investors, because I think at least half of investors we speak to would love to see that type of protection, because they are concerned that, particularly in the use of proceeds context, there's not a lot of protection they have if the money is used towards non-environmental purposes. It is very much still a gentleman's agreement. The challenge to date has been that while we have these ICMA and LMA, etc., market standards, that they're still seen as being quite permissive, and it's quite hard not to find projects that are somehow loosely connected to those standards. The introduction of the EU green bond standards probably allows for more of a scientific-based approach to green use of proceeds, which could potentially be a neat feature to then link in any prospectus for a callable or other investor protection feature, because I think that will come because the amount of scrutiny around green standards is only increasing.
Thanks, Arthur. And Nathan, just perhaps comment on the banks scrutinising KPIs.
Yeah, in terms of how banks look at the KPIs and the targets now they scrutinise those, it can really vary bank by bank. The banks that have dedicated sustainability finance or ESG advisory teams are going to have the expertise to discuss and talk through proposed KPIs and targets, and are going to provide more input on that. Other banks who don't have those resources are likely to be a bit quieter in terms of those conversations around the KPIs and how the targets are set. But I expect a majority of the banking market are, increasing their resources and what they're doing around sustainability and ESG as a whole. So I think the discussions and the focus around that is going to increase, and the fluency of those conversations. And also I think going forward, and as we see in other financing markets as well, there's going to be a greater sophistication of targets. It's things like having multiple KPIs, it's including social and governance related targets alongside environmental, etc. So as that develops, I expect greater scrutiny and conversations and the sophistication of KPIs to increase. And it's something that's actually really apparent, in investor presentations, capital markets days, etc. You're seeing more and more questions around sustainability and far focus from the financing markets as a whole only increasing.
Great, thanks for that. We've had another question come in from Kent Anderson. Arthur's probably one for you. When issuing a sustainable bond, if net proceeds initially is only partially invested up front, what are the requirements for placing the residual amount short term? Must the residual amount be parked in green instruments? It's a good question.
Yeah, it's indeed a very good question. The answer is that's not currently market practice. So the majority of frameworks in the management of proceeds section, so where it talks about indeed what do you do with the money if you haven't quite met your green or sustainable investment commitment. In the majority of cases, it refers to standard treasury liquidity tools, be that money market funds, be that deposits, buyback of commercial paper, etc. So there's quite a lot of flexibility there. Now, is it additive to say that we'll prioritize green or ESG focused short-term cash and cash equivalent instruments? Absolutely. It does show that you're aligning your cash investment and management strategy with your overall financing strategy. The challenge is there's not a lot of instruments yet available that fit the bill there.
Thanks, Arthur. I think we've reached the end of the questions that have been asked for now. So appreciate you taking the time, both Arthur and Nathan, for walking us through that, and thanks everybody for joining today's webinar and providing your questions.